Well, the general idea is that it's a bit like your portfolio. If you're an investor, for example, you want to figure out what you're worth. You use today's prices, or at least what you think are today's prices. You plug them in. It tells you what you're worth. So the sort of contrast, if you like, is in many different parts of financial accounting, people can use alternative methods of valuing assets, the sort of historical costs, for example, or other aspects that aren't so variable. And in fact, if you get into the issue, you can see why mark-to-market for all the supposed benefits, the idea was that you would have a better picture on how institutions are doing. There were some downsides that were not thought about until the situation we got to right now.
All right, so if I'm understanding correctly, mark-to-market means, for example, let's take a bank. Doesn't have to have any name, just a bank. That means that they have to go to their books and mark the various investments and loans they have to current market conditions. Is that fair?
Yeah. The problem is, and one of the problems that continues to sort of hang over the market, is that certain of the things that were created, some of the derivative-type products, all of this sort of Frankenstein finance offshoots that we saw over the past decade, a lot of them don't really have a market, or their value can only be assessed by a combination of guesswork, computer models, past price history trends, other markets, but nothing that you can see on a screen. It's not like you can sort of ask your broker where a stock is trading, Newmont Gold, where's Newmont Gold trading? You can get a sense of that's the market. With some of the things the banks got involved in, there is effectively no market. So the issue has come up is that the banks and now arguably the regulators and the establishment are letting financial institutions veer away from that somewhat and allowing them to put artificial market prices to create the impression that things are better than they are, that they're worth more than they are, and that they're in better shape than they are.
All right, well, that was exactly my impression. So suspending mark-to-market rules would allow us to sort of lie to ourselves. Is that...
Yeah, and the thing is, it was great on the way up because, house prices were rising, financial, stock prices were rising, bond prices were rising. So what the banks did is they used that sort of increasing value, which was there all the time for everyone to see, and say, you know what, we can get, because our value has gone up, that means we can speculate even more. We can borrow even more money, and we can really, sort of turbocharge our returns. But, like most pyramids, when it goes the other way, then it all sort of is a sort of mirror opposite image. And the problem is that everyone thought it was wonderful on the way up, but now on the way down, they realize that it's not really the kind of scenario you want to see.
Are we back? Can you hear me?
Sure.
Okay, we lost your audio, Michael, for a moment. So anyway, a lot of people have suggested that suspending mark-to-market would allow these institutions to, write back up the value that they think it. Well, I don't know how they would decide, but to change the value and not be required to mark to what the market is, and sort of lie to ourselves. Now, if they were to suspend mark-to-market, it's being argued all over the place. Would it help?
Well, in the past, the banks, there's a term called regulatory forbearance, and it basically means, if you want to simplify it, the regulators look the other way until sort of, you have the element of time, you have businesses carry on for some period earning money, and that they slowly eat into the loss and make themselves whole again. It's a bit like a breathing space. But the problem is now is that it's created tremendous problems because people don't know who's really got left holding the old maid card, essentially. So they believe everybody has the old maid card, and the whole system's locked up. I mean, it's eased somewhat from what we saw, say, in the depths of last quarter, but people don't want to commit themselves. Banks don't want to lend to each other. They're afraid of the companies they do business with, what their real exposure is. So it's kind of backfired now because in this idea that they're going to sort of save the system, they're in the process of breaking the system.
Okay. All right. Now, credit default swaps and instruments like CDSs. What can you give a sort of an explanation that people will understand?
Sure. And in fact, it's one of the topics, derivatives generally, is one of the topics I tackled in Financial Armaggdon, because people were so uninformed, and it was in the sort of financial industry's interest to keep people uninformed. But in simple terms, it's a form of insurance. Okay, what it is people are trading contracts that allow you to decide whether you want to have less or more exposure to whether a company is going to get into trouble credit-wise. So if you think a company is going to have problems in future and you buy a credit default swap, if that comes true, whoever sold that credit swap to you, like an insurance company, would have to give you the money to compensate for the losses, say, on their bonds, or that's normally what the reference is. But the difference between when it was a up-and-going company and when it was when it got into trouble or into default or into bankruptcy. So it's just a form of insurance, effectively. But what it also allowed was people to speculate on whether companies were going to survive, which companies are going to do well and which weren't in terms of their sort of financial position. But it brought in all of these speculative elements, hedge funds and the banks, and it created this huge sort of bubble in its own right, this bubbling market that lost touch with the underlying market. I mean, I'm sure many of your listeners are familiar with the idea of futures in Chicago, futures on grain prices. Well, it's one thing to have a sort of mechanism that helps protect farmers and protect bakers, in fluctuations of the price of wheat. But when the sort of maniacs are running the asylum, the ones who are purely speculators, who have no interest in what the farmers do and no interest in what the bakers do, then you get a crazy disconnected market, and I think that's exactly what we got.
All right. Well, here's an explanation I heard on a show the other day. They said a credit default swap, one of them anyway, one type might be, for example, thousands of mortgages. Now, you take those thousands of mortgages and you sort of package them together, and you sell them as a credit default swap. In other words, as you mentioned, a kind of insurance policy, as it were. Well, we all know that home prices, have just people are upside down in their homes, way upside down. So the moment that happened, you have these credit default swaps purchased by maybe some poor slob up in Iceland, let's say, and they bought these derivatives, credit default swaps or whatever. And when the house prices fell, these AAA rated derivatives became not so AAA anymore. And of course, we know what happened to Iceland.
Well, I mean, yeah, there's a little bit of fine tuning in your explanation. What you were describing in terms of packaging loans, for example, was one of the reasons why we had the mortgage boom, and these loans were packaged into what were called mortgage-backed securities, which are effectively a form of derivative. I mean, there's many different kinds of derivatives. Credit default swap is one kind. Right. Let me just take a step back. I mean, a derivative is any security, essentially, that bets on something else, that whose value is based on something else. And it's like if you get an option on a piece of property, well, the value of that option changes depending upon what happens to the price of the property. So it's really, that's what a derivative means in simple terms. It's something that is whose value is determined by something else.
And who is it, Michael, who determined that these credit default swaps or whatever kind of derivative were rated AAA? Who sat down and decided that?
Well, it was extraordinary. It was an extraordinary combination of corruption and incompetence, I think. The problem is that, for example, like many things in life, people became overly dependent on who they thought were the experts. In this case, they were the rating agencies like Standard & Poor's and Moody's, for example, that they knew what they were doing. They had rated sort of, corporate bonds and municipal bonds and all sorts of instruments and companies through time. And I guess they did a reasonably good job up till a sort of a decade or so ago. Never a great job, but, reasonable. But the problem is that